Hello or hello as they say in Germany. My name is Bashar Fakhry. After several years of teaching her, my computer has made progress in pronouncing my name. I am an assistant professor of research, specializing in behavioral finance, at the School of Accountancy and Finance at the University of Lahore. Welcome to my presentation. Did Brexit change the behavior of the United Kingdom's financial markets? This presentation will follow the ensuing path. Firstly, I will introduce the research and key background issues. Secondly, due to the economy being the main source of volatility during the Brexit process, and in the aftermath, I will review the impact of Brexit on the United Kingdom's economy. Thirdly, I will be reviewing the reactions of market participants to Brexit. Fourthly, I will be looking at the volatility model specification and our test of the stable market in the methodology, which will include a look at the data used. Our empirical evidence of the impact of Brexit on the United Kingdom's financial markets will follow. And finally, our views and conclusions. I have included some cartoons to illustrate the Brexit at different stages and for light entertainments. Hope you enjoy the ride. I'll promise you it won't be a bumpy ride like Brexit. First, I will give a brief introductory to Brexit and look at the background issues. Notice how opinion is split about Brexit. In an unprecedented move, on the 23rd of June 2016, the UK voted to leave the European Union by a close margin. The result signalled the start of the so-called Brexit process, named aptly after Grexit. On the 29th of March 2017, the government initiated Article 50 of the 2007 Lisbon Treaty, which sets out the steps required for withdrawal from the EU. Yet, was it a shock? Well, in a way, no. As Engelhardt and Norris 2016 amongst others state, the signs were there from the start. Populist policies has been at the heart of the Brexit vote from the start. According to Engelhardt and Norris 2016, there are two theories on populist policies: economic insecurity perspective and culture backlash thesis. Both theories are underpinned by common grievances: immigration, integration and globalization. Put simply, people were feeling left out, meaning they turned to populist policies. We'll come back to this point in the next slide. However, the counter-argument is why risk economic insecurity, instability and uncertainty. A point to be argued in next section. Furthermore, in the wake of the Brexit vote, the financial markets became very volatile, with the pound plunging to a 31-year low and global stock markets losing over $2 trillion. This hints at the overreaction hypothesis in play. We will further research and analyse the impact of Brexit on the United Kingdom's financial markets in sections 3 and 5. Governing party divided and still is. Population divided along age and class lines. The election called to strengthen the government's hand in the negotiations resulted in a hung parliament, with a deal done with the DUP, and a weaker government, than before the election. The emergence of populist policies on the continent is illustrated by the French election with Marine Le Pen and her political party, National Rally. The German election, where the radical right-wing populist party, Alternative für Deutschland, become the third largest party. The Italian election, where the populist right-wing party, League, and anti-establishment party, Five Star Movement formed the government. Both parties want out of the European Union. I'm sure will be called a Telexit or something along these lines. There are noises the Netherlands want out as well. The Catalonian independent referendum, which caused the Spanish mini revolt. The research is a timeline analysis of the impact of Brexit on the stability status of the United Kingdom's financial markets from the 8th of June 2007 to the 29th of December 2017. The financial markets are equity, foreign exchange, gold and sovereign debt. The stability condition relies on the variance-bound test fused in Fakhry and Richter 2015 and extended by Fakhry and Richter 2018 to include the long and short-run components of volatility. Since it has been established there are differences between the long and short-run price volatility, as hinted by Engel and Lee 1999 amongst others. Remember, markets do tend to follow leverage and feedback effects, as hinted by Black 1976 and Engel et al. 1987 respectively. Our main contribution is the stability condition status underpinned by an asymmetrical component C-GARCH-m model. We also contribute by analysing the impact of Brexit on the United Kingdom's financial markets. Since, as hinted before, the economy is the main source of volatility during the Brexit process, and in the aftermath, hence I will now briefly review the impact of Brexit on the United Kingdom's economy. Notice the different opinions of just what is meant by Brexit in the first cartoon. The second cartoon illustrates the difficulties in the Brexit process. Oddly enough, the road resembles the infinity sign. An important observation is the real source of price volatility and uncertainty comes not from the United Kingdom leaving the European Union but from the impact of Brexit on the economy. As illustrated in the graph, the uncertainty level rose during the European Union referendum and Brexit period. On closer inspection, the uncertainty level rose to its highest level in the aftermath of Article 50. According to the statistics, the economy is predicted to contract by anything up to 7% in the short run, meaning a cumulative effect as large as -9.5% in the long run. The variation in the statistics highlights the indecision as to which agreement, if any, the United Kingdom's government will pursue. And hesitation is driving the high levels of uncertainty, as illustrated in the graph in volatile markets. A review of the alternatives suggests there are only 3 realistic options available: soft Brexit, hard Brexit, or a free trade agreement. Soft Brexit option: the United Kingdom would retain membership of the European Economic Area Agreement but would leave the Custom Union. Thus, meaning it would retain free market access for goods, services and capital. However, this would mean free labour movement and continued contribution to the European Union budget, 2 main issues behind the Brexit Leave campaign. It would entail the continued adoption of European Union legislations. Hence, in a speech to the House of Commons on the 7th of September 2017, David Davis confirmed, the UK will no longer participate in the EEA agreement once it leaves the European Union. The second option, hard Brexit, entails a complete and total divorce without any agreement leading to the unilateral adoption of the WTO trade agreement, favoured by the economists for free trade and many on the right wing of the government, along the lines of the EU and China-US agreements. Under this agreement, goods would be subjected to most favoured nation tariff, which on average was 4.4% for the European Union. The issue is there isn't a similar agreement for services. The third option, most favoured by the UK government, is to negotiate a new deal such as the EU-Canada agreement. There are several issues. Firstly, time, as hinted by Michael Barnier in an interview with Detached on the 24th of October 2017, 3 years if we start talking in December. It comes with risks too, because all parliaments have to give approval. As an indicator, the Canadian deal took 8 years. Secondly, higher tariff, in order to keep the benefits of being in the EU. Thirdly, services, or more importantly to the United Kingdom, financial services, are not included, as Michael Barnier states at a press conference on the 18th of December 2017, there is no place. There is not a single trade agreement that is open to financial services. The conflicting opinions on the impact of Brexit on the UK's economy is due to the government indecision and author's standpoint. With the exception of the Economists for Free Trade, which relies on the unilateral adoption of the WTO trade agreement, which many have slated as far removed from reality. Chang, 2017, page 13, the predictions are negative growth. In the short run, the losses are likely to be between 1 and 5%. Interestingly, the cumulative losses on the economy in the long run could be as high as 9.5 to 18%. And the impact is likely to be sustained for the medium to long term. A further consequence is many companies, especially in the services industry, are considering redirecting investments into the EU. Accounting for the foreign direct investment loss, HM Treasury predicts an impact of -7.5% on the economy in the long run. The reality of the situation is, unless the United Kingdom can somehow maintain full access to the EU market without a high price, Brexit could have a sustained negative impact on the economy. Now I'll review the reactions of market participants to Brexit. There are 2 options available for market participants caught in the dark storms of Brexit. The first is to invest in safe haven assets, as illustrated by the first cartoon, and the second is hedging with the derivatives market, as illustrated by the second cartoon. Bernard Baruch was quoted as saying, "What is important in market fluctuations are not the events themselves but the human reaction to those events." Naturally, financial markets are highly reactive to any event or economic indicators inducing high uncertainty during Brexit. The pound fell by 2% and 1.5% against the dollar and euro respectively on the announcement of the EU referendum date. An example of the overreaction, the pound-dollar rate closed at lowest for 31 years, and global equity markets lost over $2 trillion in the aftermath of Brexit. There are 2 main viewpoints. The first is this is essentially an overreaction increasing with time due to the EU referendum and resulting Brexit. The second is this is a general overreaction due to naturally volatile markets. 2 recent examples of overreaction. the Greek sovereign debt crisis which enveloped the Eurozone hitting the GIPS nations hardest, and the subprime crises which grew into a full-blown global financial crisis. The funny thing about these cases is both assets accounted for an insignificant percentage of the capital on the bank's balance sheets and capital markets in general. The underlying reasons for the overreaction are always the same as illustrated. Conflicting information, misinformation, political miscommunication, disagreements, confusions, misunderstanding. Lo and behold, surprise, surprise, the same set of reasons underlay the reactions during the referendum and aftermath of the Brexit vote. Thus, underlining the accusation, governments never learned the lessons of past crises. In a survey commissioned by the Centre for Macroeconomics published on the 25th of February 2016, a significant majority thought there will be a hike in volatility due to the EU referendum and possible Brexit. A key factor is the correlation between the importance of the originating organisation person and the reaction level. This was evident during the financial and sovereign debt crisis as well as the EU referendum and Brexit. There is a correlation between political and market uncertainties during the referendum and Brexit process, for example the 2017 British general election. Market participants seem to react to poll updates. Historically, markets don't like change, so they reacted to polls showing a vote for change during the referendum. Market participants reacted to statistics and speeches on the prospective health of the economy in the aftermath of Brexit during the referendum and Brexit process. Large levels of economic uncertainties affected the confidence of investors, leading to the repricing of uncertainties and risks posed by Brexit, causing financial turmoil. Furthermore, credit rating agencies have hinted of a possible downgrade depending on the final agreement. As illustrated in this cartoon, the funny thing is that just when the central banking environment thought they were out of the crisis period, they were now faced with the Brexit issue. We will now look at the model and test underpinning our stability test. We will also look at the data used in our empirical section. I'll briefly discuss the theoretical basis and model description, which can sometimes be tiresome. Conventional wisdom dictates there is a difference between long and short runs. Generally, markets are less volatile in the long run, thus indicating a more rapid short-run volatility mean reversion. Moreover, there are different long and short-run sources affecting volatility. Additionally, theory dictates the price usually reverts to the fundamental price in the long run. Essentially, market participants' reactions tend to deviate with time. Thus, Ingle and Lee 1999 introduced the component C-GARCH model distinguishing between long and short-run volatility. Often there is leverage effect, meaning a negative correlation between price and volatility. Coincidentally, there is a distinction in leverage effect from long and short runs. Furthermore, theory dictates market participants require increasingly high risk premium for risky assets, a feedback effect. A notable observation is both leverage and feedback effects are largely short-lived, hinting at being short-run components. I won't bore you with the details. Sufficient to say the model is split into two components called permanent, long-run component, and transitory, short-run component. Of importance is the symbol M, which indicates the permanent component of volatility in both equations. The mean equation is a short-run model of the variance of the price. Conversely, the feedback and leverage effects are in the short-run equation of volatility and mean. The stability test is based on the variance-bound test introduced in Fakhry and Richter 2018 to test the efficiency in the long and short runs. The key to any variance-bound test is a market could be regarded as not volatile if the resulting test statistic is less than or equal to the optimal F statistic. Therein lays the key to our stability test. Since basically the variance-bound test is an assessment of how volatile a market is, thus we could test the stability and analyze the volatile levels of the market. Remember, a market could be highly volatile without exhibiting high volatility levels. Our key issue with our test is the denominator in the equation, more specifically the standard deviation, which means the test could be highly biased. Hence, we use the modifier to correct the error within reasonable standards. For our data, we used the daily price index of key British financial markets observed from the 8th of June 2007 to the 29th of December 2017. We used a 5-day week and filled all missing data with the previous data. In order to overcome the issue of highly biased results, we modified the data by division using a modifier. As illustrated in the table, we used FTSE 100 obtained from investing.com using 250 as the modifier. UK Sterling Gold Price Index obtained from the World Gold Council using 25 as the modifier. sterling effective exchange rate index obtained from the Bank of England, modifier wasn't required. However, due to the required data not being freely and readily available across the observational period, we obtained the sovereign debt data from two sources, Barclays Capital and Standard & Poor's, covering the crisis and Brexit periods respectively, using 2.5 as the modifier. Now for our empirical evidence of the impact of Brexit on the stability factor of UK's financial markets. Remember, our stability test is a variance-bound test used in Fakhry and Richter 2018, where the underlying model of volatility is the asymmetrical component GARCH-m. We analyze the asymmetrical, gamma, and feedback, lambda, effects, the long and short runs of volatility persistent, rho and beta, and shocks, p and alpha. Additionally, the long and short run stability status and volatile levels. We use timeline analysis to analyze and distinguish between the crisis period, global financial crisis, global deep recession, Eurozone sovereign debt crisis and US fiscal cliff crisis, and Brexit period. The crisis period was influenced by four factors, leading to a period of sustained uncertainty and highly volatile global financial markets. The financial crisis started with the subprime mortgages in the US and quickly enveloped the global financial sector. The sovereign debt crisis started with the Greek deficit revision, gradually becoming an issue of confidence in global fiscal policies enveloping the GIPS nations. The deficit debt ceiling crisis was a political battle between the two main parties in the US about the maximum debt and deficit levels which closed the US federal government. The fourth factor is the deep recession resulting from the financial crisis. An added issue was the confusion and miscommunication by the policymakers, which heightened uncertainty during the financial and sovereign debt crisis. As you can see from lambda on the table, there is a negative feedback effect, meaning higher risk premium are required to invest and hold on to risky assets. The main feedback effect during the crisis period is in the equity market. However, the gold and sovereign debt markets also exhibited high feedback levels. Rho is signaling a high long-run persistent level throughout the four UK's financial markets, and P is displaying a highly reactive market in the equity, FX and gold. The equity market has the highest level of reaction to market shocks. Gamma is highlighting a leverage effect for all markets. This means market participants react to negative shocks with greater intensity than positive shocks. The sovereign debt market has the highest level. Beta is pointing at low persistent levels. The equity market has the highest persistency. However, alpha is hinting at highly reactive markets, with the FX, gold and sovereign debt displaying high reactive levels. A look at the stability statistics and status would tell you the equity market is volatile in both the long and short runs. However, closer inspection of the statistic in the long run seemed to be indicating there is a thin line between stability and volatile. In the short run, the stability statistics is pointing at a highly volatile equity market, meaning it is truly inefficient due to the market being volatile in both the long and short runs. Over the long and short runs, the FX and sovereign debt markets seem to be stable and thus efficient markets. The gold market seemed to be accepting the convention: markets are volatile in the short run and stable, thus efficient in the long run. The explanation is simple. During this period, the heaviest impact fell on the equity market. Remember, both the financial and sovereign debt crises had a real impact on the UK's banking sector, with the probability of the balance sheets containing the affected assets. The other factor is the deep recession affected the retail and construction sectors, which meant the equity market exhibited a highly volatile status. Towards the end of the observed period, another factor came into play: the uncertainty created by the EU referendum, which made the equity market highly volatile. The UK's FX and sovereign debt markets weren't hugely affected by the crises or recession, hence the stability status. Although during the EU referendum the FX and sovereign debt markets did become volatile, however this did not impact the stability status over the whole observational period due to the cancellation shift. It must be noted the cancellation shift states: if a market exhibits both highly volatile and stable periods within the whole observational period, then they could cancel each other out. Hence, the reactions of the market participants reduces to a long-term stable market. The gold market acceptance of the general convention provides an interesting case. Remember, the gold market is the global haven commodity. Therein lays the key to the behaviour. The market is prone to highly volatile flight episodes in the short run, mainly due to market participants' reactions. In short, the reactions of market participants to events and conflicting statements or miscommunications by policymakers and CEOs led to the equity market being highly volatile during the crisis period. This meant market participants were fleeing to haven assets, and because of the global nature of the gold commodity market, This led to the gold market being highly volatile in the short run. As with any big change in a country's direction, the aftermath of the Brexit vote was highlighted by uncertainty and a highly volatile period. Politically, the UK became increasingly unstable, especially after a snap general election which was meant to strengthen the hand of the government in Brexit negotiations resulted in a hung parliament. Economically, as illustrated previously, there are huge questions and uncertainties surrounding the economic prospects of the UK. Added to these issues, Brexit deeply divided the country. In the midst of this volatile and uncertain environment, the UK's financial markets must function. The big issue in all this is the miscommunication, indecision and arguments at the heart of the EU and UK policy making concerning Brexit. Theoretically, this has all the makings of a highly volatile financial market on its own. Added to the uncertainty of the political environment within the European Union with the rise of populist policies as illustrated at the start of this presentation, we have an environment akin to a vindaloo curry with a Scotch bonnet pepper and dust of ghost pepper thrown into the recipe. As you can see from the table, Lambda hints at an increase in the feedback effect in the two markets at the heart of the Brexit effect, the equity and sovereign debt markets. In contrast, the feedback effect in both the FX and gold markets are insignificant. With the exception of the gold market, Rowe points to a decrease in the volatility persistent in the long run. The gold market is approaching unity in terms of long-run persistent. P seem to be hinting at an increase in market reaction, with the equity and gold markets being significantly reactive in the wake of a shock to the market. In line with the feedback effect and previous statistics, the equity market was the most reactive during the Brexit period. With the exception of the gold market, gamma is indicating a leverage effect. Conversely, the gold market seemed to be indicating an asymmetrical effect approaching zero. The sovereign debt and equity markets have the highest leverage effect. As expected, the beta coefficient hints at low short-run volatility persistent during the Brexit period. Conversely, the FX market has the highest persistent levels. However, the sovereign debt market has a persistent level approaching zero. As is the case, the market is highly reactive during the Brexit period. Although the other three markets were also relatively reactive, especially the gold market. The stability statistics hint at stable markets in the long run during the Brexit period. However, on close inspection, the FX and sovereign debt markets had insignificantly low volatile levels. In the short run, the stability statistics and status seem to be hinting at a mixed picture. The gold and FX markets are hinting at low volatile levels. In contrast, the equity and sovereign debt markets are highly volatile markets. At the basic level, the stability tests seem to be hinting at the equity and sovereign debt markets accepting the convention, market are inefficient in the short run and efficient in the long run, whereas the FX and gold markets are truly efficient. This would also suggest in the overall scheme of things the FX market is the only market stable enough to be truly efficient over the full observational period. Now for the explanation of the impact of Brexit on the UK financial market. Remember, the gold market is a global haven commodity market, meaning it reacts to flights more than any other market. During the crisis period, the global financial market suffered several flight episodes. Due to the short lives of these episodes, the impact was mostly on the short run. Whereas under the Brexit period, the gold market did not suffer from huge global flights. This highlights why the gold market was volatile during the crisis period but stable during the Brexit period in the short run. The FX market is a different story. Close inspection of the market's environment reveals a number of key pointers. The first and probably most important fact is there was a weakness underpinning all the major currencies during this period. The second is the conflicting pointers and miscommunication by the policymakers on the UK's economy. The third is the cancellation shift referred to previously. The FX market was driven by irregular hikes in volatile levels during the Brexit period. This meant the market suffered from short bursts of highly volatile periods. I cannot stress this point enough. Over the observed Brexit period, the reaction of the market participants reduces to a long-term stable market. This explains the FX market during the Brexit period. Oddly enough, it also did explain the FX market during the crisis period. As previously hinted, Brexit is likely to have an impact on the economy and trades, hence these two factors have a strong bearing on the equity and sovereign debt markets. The uncertainty and confusion surrounding the economy and any trade deals is being highlighted by the volatile conditions in the two markets with the most significant propensity with these two factors. In reality, these two volatile markets are reacting to the market participants' evaluation of the negotiation status and the likely impact on the economy and trade. At the heart of this is the miscommunication by the policymakers on both sides of the channel. Finally, we have reached the concluding section. Firstly, I'll summarize our findings. Brexit left a country and continent divided. A snap election called to strengthen the government's hand left a minority and deeply divided government. Policymakers repeating the mistakes of the crisis period. No matter which way you look at it, the economy is predicted to shrink by as much as 2.6% in the short run, making a cumulative loss of as much as 9.5% in the long run. The true figures will depend on the agreement. Whichever way you see it, the volatile market is the product of market participants reacting to events and crucially communications actions by policymakers during the Brexit process. Our empirical results suggest the two markets with the closest propensity to the impact of Brexit, the equity and sovereign debt, are volatile in the short run. However, in the long run all markets are stable. We used a variance-bound test underpinned by an asymmetrical component C-GARCH-m to analyze the stability of the market in the long and short run. Our tests confirmed the difference between the long and short run stability status given different highly volatile environments, that is crisis and Brexit periods. 3 years on from the EU referendum, the government is still divided between Remainers and Brexiters. No outline of draft agreement, let alone an agreement, seem likely before the end of the year. And what's even more funnier is the white paper on Brexit introduced on the 12th of July 2018 was not acceptable to both sides, leading to the resignation of the Secretary for the Department of Exiting the EU, David Davis, and the Foreign Secretary, Boris Johnson. The sad thing is many are now calling for a second EU referendum on the final Brexit agreement, which will further divide the country and government. It will also create further uncertainty, leading to an increasingly volatile market. Many financial organizations have announced plans to move parts of their organizations to major financial centers in the EU, mainly Paris and Frankfurt. And many organizations are employing a wait-and-see policy with regard to investments. Economic indicators point to slow growth, with quarter-on-quarter GDP growth being between 0.2 and 0.4% according to the Office for National Statistics. One of the main factors in the EU referendum, the EU workforce, was down 28,000 in the first half of 2018, on the first half of 2017, according to the Office for National Statistics. As illustrated by our empirical evidence and by the news, the UK's financial market remains very reactive to news on Brexit, thus making the market very volatile in the short run. This is mainly due to the uncertainty surrounding the policy of the government and the economic prospect of the UK. And so we conclude by this statement: it is essential to note market participants are at the basic level Homo sapiens who react to events and policymakers' communications. Whenever there are miscommunications or disagreements from the policymakers, markets tend to be volatile. Thus, the key to any event, and especially one of Brexit proportion, is the information filtering in the aftermath of the event, be it statements or statistics, needs to be collated and, more importantly, not conflicting, if markets are to remain stable. Furthermore, agreement on the course of action needed in the aftermath of the event is essential. Hope you enjoyed my presentation. Have a nice time and goodbye, my fellow researchers, or as they say in German.
Haben Sie eine schöne Zeit und auf Wiedersehen, mein Forscherkollegen.
Question time.